Holy smokers, this ain't no dang jokers. Do we have a lot to talk about in today's video, guys? I've been prepping this one for a while. I got a lot to show you, a lot of information to go through here. The financial markets are wild, okay? Completely wild. We're in a very wild time. That is 2022. I think a lot of you guys have seen the big news from today, right? The big news is Fed hikes its benchmark interest rate by 3/4 of a point, the biggest increase since 1994. Biggest increase since 1994 here, okay? Now everybody expected this interest rate hike, like that was what was expected. So it wasn't not expected. And what happened? The market took off. NASDAQ up great today. Dow went up 300 points. S&P 500 up nicely. Russell up nicely. Growth stocks up nicely. We'll look at some of those in this video here today and kind of what's going on with some of those. But yeah, I mean, this news comes out and it makes me think back to Econ 101 in the fall of 2008 when my professor told me that, if the Fed is raising interest rates, it's bad for stocks. It's bad for the economy. But here we are. The Fed does their biggest interest rate hike since 1994, and the stocks skyrocket to the moon. Okay, I guess the rest of Wall Street didn't take Econ 101. We'll talk about that in just a moment. Okay, but also what he did say is it's very possible they could raise again by basically 0.75% very soon as well. Okay, so from the perspective of today, either a 50 basis point or 75 basis point, so meaning 0.5% to basically 0.75% increase seems most likely at our next meeting. Powell also says, with inflation coming in so hot, they basically, unfortunately, have to kind of keep raising rates. Like that's just the way it is. And even when CPI starts coming down, inflation starts coming down, we're in a situation that they're going to have to keep raising rates, because even when it's coming down, it might be a 7%, 6%, 5%. It's still far too high. That's the issue we have, is because we're up in the eights right now. It's like even when things get better, it's still a high number. And so they have to kind of keep raising until we at least get under 4. And so that's still, everybody's debating on when that happens, right? But it's still a bit of time away, because you don't go from 8 to 4 like in a snap of fingers, something like that. It takes a time to kind of play out here. Now, looking at my watch list here today, very clear it turned into a risk on day. Very clear. Like I pulled up my watch list and I just looked at, I grabbed a screenshot of this because I'm looking at this on Hungry Bull. BYND up 14%, Avon up 13%, Stitch Fix up 9.6%, Shopify up 7.5%. Oatly, the Goatly up 7.5%, Lemonade up 7%. It's like, when you see those particular stocks just going beast mode, the market's going risk on. And we'll talk about if that's sustainable here in just a minute. But look at this. Big tech is roaring, okay? Absolutely roaring. And what's interesting about this is the risk, what is seen as the riskiest plays of big tech did the best. The least risky plays of big tech kind of did bad, right? And, bad compared to how these other stocks did, but Netflix up 7.5%, Shopify up 7.5%, Tesla, my Tesla up 5.5%. We're going to talk about Tesla in a little later in this video and kind of what's going on there. There's a lot that's transpiring with Tesla's business model right now. I think it's important to understand. But yeah, I mean, it's clear, like Powell came out, did his thing that Wall Street wanted him to do. And, 75 basis points. And the next thing you know, it was up and away. All of a sudden, everybody was like risk on. And it's like, wow, interesting, right? FinTech also going beast here today. But what's interesting about this? Very interesting is look at Hood. Hood still, even with a risk on day, still couldn't go up. The stock was down 2.5% here today. And the reason I think Hood was down here today, despite almost everything else in the stock market pretty much being up, except a few stocks that we'll look at in just a moment. In terms of Hood, here's the deal. When the Fed's raising interest rates, right, that makes margin debt more expensive. The Hood obviously is a player in the margin market, right? Because, there's a decent amount of folks that are on Robinhood that not only buy stocks through Robinhood, but they also basically trade or invest on margin. The more expensive margin rates are, the more likely investors, traders are not going to go on margin, essentially, right? Because it just gets more and more expensive. So basically every single stock brokerage out there to basically, starting very quickly here is going to have to raise all their margin interest rates and up another, basically 0.75%. And that hurts the amount of people taking out margin debt, right? Which obviously does hurt the stock market, at least to a certain extent. Now, if you look at safety stocks, this is quite interesting. These stocks haven't been doing good in the market recently. And that's, in a downward market where you would think safety stocks would do well, but these stocks haven't been doing good. But then you get a risk on day like today, and these stocks still don't do good for the most part. I mean, look at, most of these safety stocks were, not even 1% up, and a lot of them were red today on a good green day. So it makes you think, how do safety stocks go up? If the market's going down, these safety stocks are going down. And if the market goes up like today and it's risk on, they're still going down or doing nothing. And it's these sorts of stocks just can't catch a break right now, right? Speaking about can't catch a break, housing stocks. I'm going to show you something insane that's going to blow your mind in regards to housing in just a moment here. But, Pulte is down here today, CCS down, KB Homes down, Rocket down again. Rocket's now below $7 a share. Rocket I'm interested in probably next year. Rocket might be a stock I'm playing in 2023 or 2024, but obviously their business model is just in a bad place for quite some time with, mortgages are going to drop off massively, already are dropping off massively. Refinancing is done. I mean, just done for at least the next year, but it could be multi-years in terms of refinancing just being a dead business model essentially. And so that's just kind of a disaster. And but when it comes to housing, look at this. This is going to blow your mind. Okay, a friend sent me this today. Home builders are starting to cut prices on quick move-ins. Okay, they're starting to cut prices. A friend sent me this today, and I was just like, "It's starting, man. It's starting." And we have not really seen this play out in a long time, where home builders are starting to cut price. But this is just the tip of the iceberg, what you're seeing here. These little price cuts are going to turn into much bigger price cuts because all these home builders now at this point in time are starting to realize, oh crap, man, that demand is going away and it's going away rapidly. The real estate market, where this real estate market was red hot 2 months ago or 3 months ago, is not the same today. And it's going to be even worse a month from now and even worse 2 months from now. And so a lot of these home builders are starting to realize, oh man, the stuff is hitting the fan. We better try to move these properties as quick as possible, or we could be sitting on these for 6 months, 12 months, 18 months, 24 months, and then have to discount much more substantially to get people interested, right? Because as interest rates continue to go up and up and up, it's decimating the real estate market. Plus, you have, affordability, the worst we've ever seen it in history of the United States. You have everybody getting sliced and diced by inflation. You have extremely low confidence, which leads to people not wanting to buy new homes, obviously, right? And who wants to take out a mortgage right now at 6-something%, right? And we're likely going to 7% on a 30-year pretty soon here. And so the housing market's going to get absolutely obliterated. New home, the home builders are going to get absolutely obliterated. And so they're starting to panic and they're starting to say, shoot, man, we better start cutting prices, doing whatever it takes. Now, when you see price cuts like that, they'll still negotiate. So meaning essentially you could go in there even with their price cut, right? Let me use an example to show you here. So let's say there's this house, right here that they just cut price by almost $10,000 on, right? You could still go in there and say, you know what, how about, $585? And they would probably counter back with something like $595 or $599 or something like that. Can't guarantee it, but more than likely they would in this sort of market right now, because I almost guarantee you they're starting to get pressure up the ranks from the managers up the ranks saying, hey man, we got to start moving these quick move-ins or we're going to end up sitting on inventory for a long time, or having all of a sudden go from a $9,300 discount to a $29,300 discount to a $49,300 discount to a $100,000 discount. And, eventually if you discount enough, all of a sudden that home you built, you actually ended up losing money on. As of right now, I can almost guarantee you they're still making a good profit margin on that. But if all of a sudden, they had to cut price $90,000, that could be a totally different situation, right? And so I guarantee you they're getting major pressure right now, major pressure. And once again, this is just the start. This is just a start. It's going to get much uglier before it gets any better when it comes to that. And a lot of these home builders have started building on spec more than they usually do. And the reason they're doing that is because they've seen And prices just go up and up and up. So if you're a home builder, why wouldn't you start building for yourself rather than just, selling all lots? Start building more and more homes for yourself. Basically, you're in a situation where prices have just been going up. So whatever you thought you could have got for that property when you started building it is more in the future. The problem is the roles are starting to reverse now, and the home builders have built all these quick move-ins, as they call them, which are basically just spec homes, that all of a sudden they're like, oh boy, where's the demand going? We're going to be stuck with all these. And, we put $500,000 in this house. We put $1 million into this house. We put $400,000 into this house. And they're all of a sudden stuck with all this inventory. And so it's a horrible thing for home builders, because the next thing you know, their quick move-ins start competing with the new builds. Okay. And so all of a sudden, if there is that rare customer out there, let's say in July, that's actually looking to buy a new home, now they have all this used inventory on the market, right? But here's the most important part. The most important part. Now all of a sudden they got quick move-ins that are being discounted. So all of a sudden they start to look at it and they're like, do I want a quick move-in that's being discounted, or do I want to build a new home, right? And the home builder's kind of in a catch-22 in this situation, because they're like, dang, man, we really want to sell them a new home, because you get the lot premium likely on that, and you get the upgrades. But at the same time, they're like, we're sitting on this quick move-in inventory, so the home builder's kind of like screwed in that situation. Plus, that buyer, once again, can see prices getting slashed in the used market, right? And so there might be like, you know what? I don't really need to buy that new home. New homes have done so well because there hasn't been much inventory out there for, used homes essentially, right? And so new homes have flourished. Well, that's all changing. We're seeing inventory start to skyrocket in a ton of markets, including even the market I live in, Las Vegas. And once again, that's just a start. Inventory is gonna pile up over the summer and into the fall time essentially. And so it's a bad situation for home builders, and this is just kind of the start of things in regards to that. Now, in regards to the markets, here's where we're at right now. The Dow is, as of right now, down about 17% off all-time highs. The S&P 500, as of right now, is down about 21%. The Nasdaq's down about 31% roughly in terms of off of all-time highs, and the Russell is down about 30% from all-time highs as of right now. So, they're still pretty dang close to their max drawdowns. They're only a few percent off. The S&P's max drawdown was 22.8%. And that was as of yesterday. QQQ was 33.1% there. So obviously we're in a bear market. It's very clear about that, right? And even after a day like today, it doesn't mean the bear market's over. In terms of how much these are off of their pre-COVID highs of 2020, 3.7% for the Dow, 10.6% for the S&P 500, 16% surprisingly for the Nasdaq. That's pretty crazy to think. The Russell, less than 1% off of pre-COVID highs. Okay, less than 1%. That's where the real opportunity is in this market, in the small caps and the mids. That's where the best bang for the buck will come from. But with that being said, you really need a true reversal in the market, like a sustained reversal for like a month or two to really get things to fly and get excited, okay? Now, Tesla Maesla. Basically Tesla's 10% staff cuts have kicked off now officially, with ex-employees confirming on LinkedIn they have been laid off here. So Tesla's obviously, a lot of different crazy stuff's happening with Tesla, right? Tesla's China output decline trending deeper than Musk forecast. Data and internal memos show. Here's the deal with Tesla, okay? Here's the deal with Tesla. I want to talk to all the Tesla bulls for a moment here. And as somebody that's been a Tesla bull for a lot of years here, and that's somebody that's followed this company since they went public, for over a decade ago. Here's the deal with Tesla. The next few quarters are going to be messy, okay? Everybody needs to get that through their head and not get their hopes up too much. It's going to be messy. And so margins could be messy the next few quarters. Revenue could be messy for the next few quarters. The bottom line, net income, net loss could be messy for the next few quarters. Do not get too hyped or excited on Tesla stock in terms of the numbers over the next several quarters, okay? Never mind that. We obviously have interest rates going up. We have consumer confidence, basically going through the floor right now. And it's getting much more expensive to obviously take out debt, which isn't good for automobile business, okay? So, folks Tesla bulls really need to understand all the things that are kind of working against Tesla in the short term, and also understand that the long term is still there. Gas prices going up. Yes, that hurts the economy in a devastating way here in the short term, and it's also making the Fed raise interest rates. But long term, everybody's going to remember these high gas prices and going to remember the next time they get a car, they should probably get an EV, right? So whether that purchase is in 2 years from now or 4 years from now or 6 years from now, like, the EVs are the wave, and people are going to remember, shoot, I don't want to get a gas car for my next car because I remember paying $5, $6, $7 a gallon, right? So it's just important for everybody to understand the trouble that Tesla numbers could be for the next, let's call it 4 to 6 quarters, depending upon what happens in the economy, versus where this company is going over the next 4 to 6 years. Okay. So I just want everybody to really understand that. And, for the Tesla bulls, it's not, you shouldn't get down about the short-term stuff. Like, it is what it is. It's part of the process. Every single company goes through short-term problems, and don't be in denial about it. That's the biggest thing I sometimes see in the Tesla community is they want to act like this doesn't exist. Tesla has no problems. Everything's perfect. And it's like, it's not that way. Tesla's going to have issues. They're going to have numbers that don't hit over the next several quarters. And that's just the way it is. And that's for all companies. And so don't get, don't be in denial about it. I guess that's the best thing I could say. Okay. Credit default swaps have been skyrocketing up. In this high yield. This is not necessarily a great thing to see. It's kind of a scary thing to see. We're nowhere near where things were at peak fear and Rona times, but we're getting pretty darn high. And so that is just kind of something to pay attention to there, just in the background, okay? I saw this from the Washington Post today. Generation Z is getting a harsh lesson in stock risk. The wealth destruction over the last few weeks has been brutal. Markets are down more than 20% from the start of the year. We are officially in a bear market. One estimate from last week said household net worth fell 0.4%, and that's going to fall a lot more. Just wait till real estate starts falling. Wait to see what happens to net worth. Oh boy. A bear market is never good, but this time it's especially worrying because the last few years stock investing has become trendy, with TikTok stars becoming the new investment gurus. Now first off, there's not one TikTok star that's an investment guru. There's no one that's like renowned or like invested, like respected on TikTok. This is not the way this works, but whatever. Okay. But maybe to Washington Post it is, right? Now many of these new investors are learning TikTok is not the best place for investment advice. I never thought I would stick up for the TikTokers, but here's the thing, okay? Where's the best place to learn for investment advice? Is it mainstream media, where they constantly have Wall Street analysts on that constantly tell you to buy stocks at 52-week highs and then sell them at 52-week lows? Is it watching Kramer, who could change his opinion on a stock in literally 24 to 48 hours, and he's like ultra bullish on a stock and telling everybody, buy, and then it's like, sell. Is that where? So, I kind of I want to actually defend the TikTokers for a moment here, and it's just kind of funny to do, but, I just think it's ridiculous to what are we putting on a pedestal here? Because I see a lot of crap out there all the time, and it comes from many different places. This is bottom line, right? There are many culprits to blame for the falling stock market, including policy errors that have contributed to inflation, over exuberance, or just very human tendency to forget that sometimes risky markets fall. At the end of the day, the stock market is such a representation of life. It's survival of the fittest. It's the strong survive, and the ones, just like life, the ones that learn from their mistakes, adapt, figure out the next way, are the ones that evolve, and the ones that make the money and have the success and those sorts of things. It's the stock market is just the best representation of life you can almost ever find. It really is. And those that aren't willing to learn and adapt and stay strong, those ones will fall to the wayside, right? The ones that give up, just like in life, are the ones that will fall to the wayside. That's just the way it is. The stock market is life. It's a dog-eat-dog world. And, you got to focus on yourself. You got to focus on learning. You got to make the best long-term decisions for you in the stock market, just like you do life. And, that's just bottom line there. And I think there's going to be, for Gen Z, I think there's going to be a lot of good investors that come out of this, like really good investors, like really, really good, and in pretty big numbers. And I think there's a lot that won't learn from this and will wait till the next big bull market and gamble on the bull market at the very end of it. And I think there'll be some that leave the market and say, the stock market's a scam, and they'll never invest in the market again, right? And that's just the way it is. That's human nature. It's part of the process, man. It's part of the process. Now, the stock with the S&P 500 alone has erased $9.3 trillion in market cap. Think about that number for a moment. $9.3 trillion of market cap have been erased from the S&P 500. Looking at a chart here, like look at that number. Now we're not quite to as bad as the Rona trough there, or 9.8 billion, but that's a pretty insane number. Actually, much more substantial than the great financial crisis where the S&P 500 lost about $8.1 trillion. Now market caps are way bigger nowadays than they were back then. So there's something to kind of keep in mind there, right? I mean, the equivalent of that, I think the S&P 500 would have to lose 20 to 30 trillion dollars of market cap to be somewhat in the same realm as on an equivalent basis as essentially the great financial crisis was. But yeah, it's a huge number. And so what's important to understand about this number here, and this is very important for everybody watching this to understand, is a lot of bad news has been priced in the market. Has 10% unemployment been baked into the market, and let's say banks going from making money to losing money, and big tech companies EPS falling over the next year or two? Has that been baked in? I'm not so sure about that, but do keep in mind a lot has been baked in. When you erase $9 trillion plus, a lot of bad news has been baked in. A lot of that's just the way it is. Every single time, the Rona crash, the great financial crisis, they price in a lot up front. And then you can start getting a recovery way before you really get a true economic recovery, or way before people recognize like, oh yeah, things are back on the right track. A lot of times, a lot of times the stock market's playing 6 to 12 months into the future. And it's quite interesting, especially we found throughout time when it's a big dramatic move in the market. We're talking about like an S&P 500 down 20%, like bear market type moves. Usually in those sorts of times, the bear market has a lot of conviction on where things are going to play out over the next 6 to 12 months. And so then all of a sudden you can start to see the stock market recover. And really, you don't see a true economic recovery for 6 to 12 months. And then all of a sudden you're like, oh man, these companies' earnings are getting better. Oh, things are starting to get a little better. And, but it's always like 6 to 12 months. And so that's what's very confusing to a lot of folks out there, because they can look at the market losing trillions and trillions and trillions of market cap. And sometimes it doesn't make sense to folks. And, eventually it does make sense. It's just in that time period, it doesn't make sense, right? Now, Bitcoin started to recover here. This is important, obviously. And, it's interesting. So Bitcoin, it got so dang close to dropping under 20K. And I told folks, that's the key number. And I said this, as soon as that baby breaks 25, we're going straight down 20. And that's exactly what happened. We broke 25 and we just went down like basically a straight line to 20, right? Somebody was trying to argue with me in the comments the other day. They were like, oh no, 19's the number that's important. And it's like, no. Fundamentals don't matter in the market right now. Technicals don't matter in the market. Psychological levels matter in the market. 20K for Bitcoin is the psychological level, as 25 was. And as soon as it broke 25, break down 20. If we break 20, then you're likely going to be down quickly into the 15 range, essentially, if the market continues to be risk off. And then at 15, then you could break down to 10, essentially. And so right now in the stock market and the crypto market, everything, this is not a market driven on fundamentals. This is not a market driven on technicals. This is a market driven on psychology, psychological levels. And that's what's driving this whole game right now. The whole game. No one really has any clue where the economy is truly going over the next 6 to 12 months, right? We can guess, but we haven't really seen this sort of inflation. We haven't gone through a time period where we had a big stimulus pump like we had for 2 years almost, right? And so this is an unprecedented kind of time period we're going through right now. And in those time periods, once again, fundamentals don't matter. Technicals don't matter. It's about psychological levels, okay? And so, risk on, Bitcoin will do well. If we're risk off, like Bitcoin's going to continue to falter, we'll end up falling under 20, and the next thing you know, it'll be 15, right? Somebody posted this in the private stock group. You got to have some comedy, right? Buy crypto. I said, buy crypto. Oh man, that's so good. Just so dang good, okay? I want to talk about this for a moment in flipping investors. But before we get into that, we got to get into today's sponsor of the video, which is my private stock group. And the the private Discord chat. Have you ever wanted to chat with 6-figure, 7-figure investors about stocks all day? Well, maybe you should join a private stock group. Have you ever wanted to learn about financial statements on the highest level possible? Get access to all the moves I'm making in the market and things like that? Well, maybe you should join a private stock group. That will be linked down in the description. That is our official sponsor for the day, my private stock group, okay? The AI investor sentiment has been in a bad place for quite some time, with almost 80% of investors not bullish on the market for the next 6 months. If you're talking about getting a sustained rally in the market, we have to flip these folks over to this side, or at least a good chunk of them, to get a upward momentum that is lasting more than 1 trading day or 2 trading days, okay? Now, is there anything that happened today that makes somebody say, we can flip these people? I don't know about that. The Fed coming out and raising interest rates, it gives them a little more credibility, but at the same time, that's going to ultimately end up likely hurting the economy. So, I don't know if we've done it. I don't know if the Fed coming out and raising 75 basis points is necessarily flipping these neutral people and these bearish people over to bullish. I don't know about that. But what I do know is that obviously we're at a very fear-driven market right now. When you only see 21% of investors bullish on the market for the next 6 months, that's a horrible number. Usually you're at about 38%. So we're just at a moment in time where, clearly just people are very, very bearish on the market. Like you should expect there to be more bulls than bears. And right now we got dramatically over a 2x more bears than bulls right now. That's extraordinary numbers. Neutral is kind of in line with where it should be. So I'm not completely convinced we've done something today magically that's going to get enough of these people over to get a sustained rally for, let's say, the next 6 to 12 months. Let's hope. The Chef had a good day. Obviously, a lot of stocks had a good day today. This one was up 5%. They did have their investor presentation. As far as my feelings on that investor presentation, there wasn't a lot that I was able to learn there that I didn't already know, to be honest. That's on their investor relations page for, folks that obviously own the Chef or care about the Chef. But there wasn't anything in there that I was like, oh man, I had no clue this was going on or something like that. So everything's just kind of on standard with what we're expecting. Heat map for the day. Very interesting. Obviously, a lot of green out there today, but look at the things that had been holding up well, right? Are all the things that faltered here today, right? All the things that faltered. And I don't know if you guys know, but yesterday, natural gas went down 15%. 15 flipping flapjacking percent, man. Energy is just a crazy, crazy time period right now, okay? Now, last thing I want to leave you guys with here is obviously the market still is in extreme fear. It's not like because today happened, like the market's not still in extreme fear. We're still in extreme fear on the market. And the important thing to understand, I think there's 2 things, okay? You got to continue to load up on companies you love for the long term. You have this 6 to 18 month window in front of you. I said this in the video the other day. You got to do as much as get your income up as much as possible and invest as heavily as possible the next 6 to 18 months through this whole crash. And as we come out of the crash, you get these very rare opportunities for a 6 to 18 month span where you can just add assets for cheaper prices than you ever thought you would ever be able to add those. Okay, so that's the first thing I want to say. Second thing I want to say, don't get too hyped or excited on the market like coming back in the short term, something like that. You're just setting yourself up for more psychological damage. We're in a very obviously risk off market, right? We still are. Just because today was a nice green day and, folks, you should have made a lot of money today. It doesn't mean like magically, oh man, everything's back to good. Like we're up from here. It doesn't mean that at all, right? So don't get too excited on this. Stay focused on adding positions you love for the long term and just continue to load up ownership of those companies. Remember, every share you buy of a company, you have increased your ownership in that actual business, right? Which is very, very important for everybody to understand. So yeah, hope you guys enjoyed this as always. Much love. I appreciate you joining me. If you're looking to join my private stock group, the private Discord chat, all those sorts of things, check out the pinned comment down there and have a great day.